Well, good morning, everyone, and thank you for joining us for EIF's first webinar on investing in climate and environment. My name is Adelaide Krakow, and I head EIF's climate environmental venture capital investment activities, and I'll be moderating the session today. If we can move to the next slide. So as we all know, we're really facing an unprecedented global climate and environmental emergency. Our economic and industrial development to date really hasn't taken into account the need for sustainability, which, unfortunately has resulted in climate and environmental degradation and the depletion of natural resources, which now pose real business risks and even existential threats. Not all is dire, however, and there is a growing awareness amongst all stakeholders, whether they be governments, consumers, corporates, and investors, that change is needed and that it can be effected to redress the situation. So every sector of the economy needs to transform, and companies are increasingly under pressure to, really revise their business models, innovate, integrate, and acquire new technologies and businesses that can reduce their climate and environmental footprint. Whereas 20 years ago, business investments geared towards sustainability were oftentimes viewed as a nice to have, nowadays they are really a must-have if a company wishes to ensure its long-term viability and thrive. So against this backdrop, investment is really set to accelerate, and risk capital, and I would say significant amount of it, will be critical in bringing about the innovation and level of transformation that's required. And it's pretty clear that public financing alone is not sufficient and that private capital will be vital to driving this change. According to market estimates, the green financing gap, or capital required to meet current SDG and climate goals, surpasses 5 trillion euros annually. And whilst investment is really ramping up, it's still quite far from this figure. In addition to constituting a pressing need, this represents, I would say, a tremendous market opportunity that really offers investors the possibility of achieving both far-reaching positive impact as well as financial performance. Moving to the next slide. So given its importance, climate environment is really top of the EU agenda and a core strategic area under InvestEU program launched by the European Commission. During the webinar, we'll cover different topics related to our climate environmental activities as an EU institution and one of the investment pillars of InvestEU. The first concerns EIF's institutional priorities in supporting climate and environment, which will be presented by our colleague Igne Vaishnorait. Secondly, our colleague Paula Ruiz Martin will provide an overview of the new InvestEU program, its strategic objectives and target areas with a focus on climate environment, and the types of fund proposals that we are seeking to back, together with the associated eligibility and investment criteria. She'll be joined by Maria Romano, who will explain the advisory support services that fund managers and companies may benefit from under the new InvestEU program. For the third part of the session, Cindy Daniels, Priscilla Schneppner, and myself will share market insights and highlights on EIF's fund-of-fund investment activities in climate and environment and in the market segments of venture capital, lower mid-market, and senior debt. And last but not least, our colleague Marilyn Horitz will explain EIF's approach to identifying, qualifying, and reporting on our climate and environmental targets and investments. She'll notably do a deep dive on our climate action environmental sustainability framework, which we began rolling out last year and which will be applied to all of our financing activities in the area of climate and environment going forward. We'll also try to reserve some time at the end of the session for Q&A. So as a warm-up, we have prepared a first poll for you right now. So please, go ahead and use the QR code that's up on the screen. So the question is, to what degree are environmental or climate-related aspects a relevant topic for your fund's investment strategy? And let's see if we manage to generate the results. Okay, numbers are increasing as we speak. Okay, not quite yet stable. Okay, there we go. Well, I think that overall, given the strong interest we're seeing, we certainly have the right audience for the webinar today. We also hope that by the end of the session, many of you will even consider increasing your exposure to climate and environmental investing. So without further ado, I hand it over to Igne.
Thank you, Adelaide. Yes, if you can maybe put the slides back. Yeah, we can go to the next slide, please. Yeah, so we, EIF, as an EU institution, are focused on designing financial instruments for European SMEs and mid-caps. We mainly focus on two products, debt, where we work with banks to lend more money to European SMEs, and equity, where we work with funds to provide equity, quasi-equity, senior debt investments to companies from pre-seed to late stage. Our main mandators are European Investment Bank, European Commission, and European member states. However, we are also working with other institutional investors and private investors on some of our products. If we go to the next slide, we also play an important role in designing European financial products focused on climate and sustainable financing. And we also have played an important role in developing the European taxonomy. As part of European Investment Group, we also support multiple international initiatives on climate and sustainable financing, such as United Nations Principles of Responsible Investments, a Carbon Disclosure Project, or Climate-Related Financial Disclosure Initiative, just to name a few. As European Investment Bank Group, we also prepare and publish our own sustainability report that follows and is aligned with Global Reporting Initiative, TCFD recommendations, sustainable accounting standards, and other international recommendations. Our climate ambition and goals are outlined in EIB Group Climate Bank Roadmap, which is actually available on both EIF and EIB websites, and then also will make available to you for this presentation after the webinar. And actually, we aim at supporting 1 trillion of investments in climate and environment between 2021 and 2030. If we go now to the next slide, I will a bit explain how we actually plan to do it. So basically, to make this climate ambition, or let's say to turn it into real results, and to ensure that the financing we provide is green and sustainable, we have put together several safeguards at the corporate and investment level. EIF ESG principles guide the assessment, management, and reporting of environmental, climate, and social risk and opportunities related to EIF as organization, and also to transactions we make. EIF restricted sectors and Paris alignment framework define exclusions and restrictions to our operations in relation to certain economic sectors and activities. EIB Group Paris alignment of counterparties framework assess our large counterparties alignment to the goals of Paris Agreement. And finally, our climate and environment sustainability framework defines green criteria for our investments. Later today, you'll learn more with my colleague Merlin about a CNES framework and its practical implementation in our financial operations. The policies and framework I have just mentioned are all implemented directly in our investment process, either at the due diligence stage through climate risk and ESG assessment, or through contractual clauses on, for example, EIF and Paris alignment restrictions, for InvestEU transactions, also on InvestEU restricted activities, Large funds with assets under management above 500 million also undertake to make climate travel and disclosures according to the TCFD recommendation. Now I pass the floor to my colleague Paula, who will tell you more about the InvestEU program.
Thanks a lot, Igne, and good morning, everyone. My name is Paula Ruiz, and I work in mandate management, specifically in the team in charge of the implementation of InvestEU. So in the next 10 minutes, I'm going to guide you through InvestEU equity product, including the climate and environmental solutions sub-product. Additionally, my colleague Maria Romano from the Advisory Hub will explain you what type of solutions they are offering, including the market development and capacity building activities that we are planning to launch together during the implementation period of InvestEU. To support the rollout of the product and to further development the ecosystem. This will be the first time that the EIF develops such activities in a structured way, so a big thanks to the Advisory Hub that has supported us in the preparation of this webinar as well. Next slide, please. So InvestEU Fund is the new financial instrument from the European Commission to boost investments, innovation and job creation in Europe from 2021 to 2027. It is a 26 billion guarantee, and almost 40% of it, so more or less 11 billion, is being implemented by the EIF, which aims to mobilize around 145 billion of investments. It is a thematically oriented product to support key EU policy objectives through guarantees and equity instruments, which aim at providing finance mainly to SMEs, but also to small mid-caps and mid-caps, infrastructure projects, and to a less extent to individuals and households. Next slide, please. So InvestEU Fund's main objective are threefold. You can see them on the left-hand side of the screen in pink. So first, to contribute to post-pandemic recovery by diversifying financial sources and strengthening the equity base of European SMEs. Second, to support the digital transition. And third, to support a transition to a low-carbon, resilient and circular economy, what we are trying also to do here today. Additionally, the EIF InvestEU equity product offering has, among others, the following objectives. We aim at increasing the gender balance of equity market operators and promote women entrepreneurship. So our aim is that by the end of 2027, with InvestEU, we invest at least 25% in funds that comply with our EIF gender smart criteria. Then, thanks to our Escalar product, we aim at supporting larger fund size and enable managers to follow winners for longer. We aim as well to support a conducive environment for risk capital in the impact investing space, enhance our role as market builder by supporting first-time teams, find a geographical balance by supporting nascent equity markets in Europe and investing in funds targeting modest and emerging innovative countries, as well as supporting funds commercializing academic research and innovation and business angels funds, and so on and so forth. I just brought some of them here. Next slide, please. So since the launch of the program back in April last year, we have almost 6 billion of euros to deploy until 2027 through the following equity products. So capital market union, normally targeting debt funds and hybrid debt equity funds and growth and expansion funds, which have been historically generalist, but are getting more and more thematic, as our colleagues from front office will explain us a bit later. Enabling sectors, which aims at supporting critical sectors of the European economy, such as life sciences, defense, or semiconductors. Climate and environmental solutions that I will cover shortly. Then digital and CCS, which target investments into artificial intelligence, quantum computing, blockchain, or culture and creativity sectors. And finally, social impact, which targets social enterprises and impact-driven enterprises, including in the field of skills and education. Next slide, please. So with the climate and environmental solutions of product, we aim at boosting support for research and development, upscaling and commercialization of solutions that contribute to the EU Green Deal. As most of you might know, the climate and environment sector, if we can call it like that, it's an aggregation of thematics that are cross-cutting, sometimes even overlapping, and there is not a market standard on how to classify them. As such, the InvestEU target areas
or the way we classify companies and investments under InvestEU is deliberatively broad and ranges from mobility to energy, industrial decarbonization, food and agriculture, as well as blue economy or adaptation solutions. As you can see, these 6 target areas in the screen. So in order to receive funding from this InvestEU pocket, we expect funds to target companies in the areas described in the slide. A key aspect from this product and from other products of the EIF, but I wanted to bring it to your attention, is that EIF requires funds to systematically implement an impact measurement methodology that links the carried interest of the fund with the achievement of certain KPIs established together with the fund manager at the level of the underlying companies. So we ensure an alignment of interest with respect to the positive impact of the EIF intervention. Next slide, please. I wanted to briefly walk you through some of the characteristics of and requirements of InvestEU. So first, funds have to be aligned to one of the EU policy priorities, which in turn is aligned to one of our products that I have described before, and mainly target SMEs or mid-caps in the EU. The vehicle needs to be established in the EU, although the team or the advisory team does not. The maximum ticket size that we can take is 100 million, although this cap is normally used for infrastructure funds that are not covered in this webinar because they follow a different climate and environmental criteria. The average tickets for venture capital, private equity, and private debt are much lower, normally around 20 to 25 million. The EIF has to have at least participation of 7.5% at the closing where it joins, which is normally the first closing. Private investors normally must represent at least 30% of the fund. Then investments cannot go to final beneficiaries operating in restricted sectors, including the ones stemming from the sustainability proofing requirement, which, by the way, we are developing a video shortly in order to explain to the market and to you how the EIF is implementing this InvestEU requirement. And finally, and most importantly for the remit of this webinar, is that the EIF is expected to contribute to InvestEU climate and environmental targets with at least 25% of the total investments under InvestEU. So it is important, very important to note that investing in a company that belongs to any of the target areas that I have just described does not mean that it complies with EIF's climate and environmental criteria, which are more stricter and imply certain technical requirements. Which is, this is the driver to account for this contribution, and my colleague Merlin will explain to you at the end of the webinar in the last section. Next slide, please. Additionally, on the size of the operation, so the maximum ticket that the EIF can take is 25% of the fund, but this has some exceptions, as for example, you can see here in the screen, when the fund complies with the gender smart criteria or pursues investment into impact-driven companies. And next slide. On another note, we have a minimum investment allocation requirements, which is twofold. So among the targeted companies by the fund, in terms of type of companies and location, the fund has to invest 2 times EIF's commitment and at least 50%, with a cap of 80%, into EU SMEs or mid-caps. And regarding the sector or the target areas, the fund has to invest 2 times EIF's commitment with a cap of 80%, so there is not a minimum in that respect, to invest in the target areas, for example, for the climate and environmental product that I have described before, these 6 target areas. And in the next slide, and just to finalize with my intervention, I wanted to provide you with an example of the minimum investment allocation. So imagine a 100 million fund with a mixed strategy, targeting, amongst others, climate and environmental solution investments. It has received a 20 million ticket from the EIF, and as you can see in the screen, at least 2 times of EIF's commitment with a floor of 50% should be invested in SMEs or mid-caps located in the EU. Given that in this case 40 million, so the 2 times EIF commitment is lower than 50%, the ticket should be invested in EU SMEs and mid-caps, 50 million. Again, the 2 times indicative of the EIF ticket for the target areas, but in this case we have this 2 times 20, 40 invested in this climate and environmental solutions product target areas. If you have any questions apart from the Q&A section, we have a generic email to which you can address your questions and that you can find in the last slide, which is investeuequity@eif.org. You can also find in the annex the link to the EU application, InvestEU application, in case you want to opt to receive to InvestEU support. And with this, I leave you with Maria. Maria, the floor is yours.
Good morning, everybody. My name is Maria Romano. I am part of EIB Advisory Services, where I am in charge of the Capacity Building Programs team. Our main focus is to design and implement advisory solutions for financial intermediaries, like fund managers, in order to support them in the deployment of EIB Group intermediated products, like the InvestEU equity products of EIF that Paula has just explained. And how do we do it? How is this advisory support financed? Well, we use the InvestEU Advisory Hub, which is a program offered by the European Commission, which is aligned with the general objectives of InvestEU, and the 70% of which has been entrusted to us, to the EIB, for management. So the EIB is the main advisory partner of the European Commission for the InvestEU Advisory Hub. Very briefly, I can mention the main goals of this advisory hub, and these are support the identification, the preparation, development, structuring, procurement, implementation, and anything related to investment projects. It's as well to enhance the capacity of promoters and financial intermediaries to implement financing and investment operations, and as well to support awareness raising and preparatory activities for investment areas where there is a clear market gap. So you can see here in this slide the different sectors and activities eligible for getting this support from the InvestEU Advisory Hub, which range from sustainable infrastructure to social investments and skills, also targeting research, innovation and digitalization, small and medium-sized companies, as well as other cross-sectorial thematics, like for instance, gender, just transition, or the circular economy. So as you can see, a very wide range of sectors and activities aligned with the ones targeted by the InvestEU Guarantee Fund and the equity products, and out of which climate action and environmental sustainability is a fundamental pillar. So now if we can please move to the next slide. And then now getting into more concrete activities for intermediated products. You can see here in this slide the main catalog of services we provide. As you can imagine, not all of them would apply to all products, and similarly to not to all fund managers, because not all of them need the same level of support. So our intervention always takes into consideration several factors, like the level of complexity or sophistication of the product, the already existing capacities and expertise of the concrete fund managers, and also the areas of support where the impact can be more effective. So now we'll give you a very broad overview of the type of activities we generally provide. I only have 5 minutes today to present, but of course, we are already working with the EIF on developing as well ad hoc support packages for fund managers in the area of climate action and environmental sustainability. So we can say that our services are mainly divided into two categories of support. On one hand, we have the capacity building support packages for intermediaries. And by this, we mean, for example, tailored trainings, like coaching, peer-to-peer visits or workshops, product development support, where we can help the portfolio analysis and the pipeline building, project origination and preparation to understand how to assess projects, what the concrete eligibility criteria for the specific product are, product implementation support with impact measurement, monitoring, and reporting, and as well the development of web-based or IT tools. Like, for instance, in this case, it would be to understand better EIF's climate action and environmental sustainability guidelines and assist fund managers with the assessment and the reporting process. And then we also carry out market development activities to contribute to the market uptake of InvestEU. So we prepare communication and awareness raising, like promotional materials and case studies. We promote the exchange and dissemination of good practices with networking events and workshops. And we also carry out market studies to provide analytical support. So this has been a very quick overview of the InvestEU Advisory Hub and of the activities that we at the EIB carry out in support to intermediaries, which, by the way, are offered free of charge, thanks to the European Commission and the EIB Group support. And then, as Paula was saying, we are working very closely with our colleagues at the EIF in all this process. So we will be getting in touch in the coming months with you with more details about the specific advisory solutions we will offer to fund managers. Thank you very much. Adelaide, if I'm not mistaken, back to you.
Thanks, Maria. So moving to the next slide, great. So as explained by Igne at the start of the webinar, EIF's primary mission is to provide financing to innovative and high-growth European ventures and companies. We don't provide direct financing ourselves, but rather partner with financial intermediaries that have the necessary proximity to market to identify the companies we seek to reach and support them with value-add expertise in addition to much-needed capital. Within climate and environment and through our fund-to-fund activities, we're channeling equity and debt financing to SMEs, as well as funding infrastructure projects. Over the next few slides, we'll share some highlights on our activities across venture capital, private equity, and senior debt funds, as well as some insights and trends that we're observing in the market. Next slide, please. So given our mandate, EIF is certainly one of the biggest providers of risk capital to SMEs across Europe. Since our inception and within venture capital alone, we've invested over 16 billion euros in 560 VC funds and have partnered with over 350 fund managers. I would say that no other fund-to-fund investor today has a comparable level of experience or coverage of the market. And our activity has, grown strongly over the last year and currently stands at an annual run rate of 3 billion euros per year. And next slide, please. EIF is also a long-standing and committed investor to the climate environmental impact space. Our first clean tech VC fund investment actually dates back to the mid-2000s and coincides with the first clean tech wave. Since then, we've committed over 1.3 billion euros to close to 50 venture capital funds, which in turn have helped to mobilize 4 times the amount of our capital from third-party investors. So based on our activity, we were actually recognized by the Clean Tech Forum a few years ago as Europe's largest and most active LP of the decade in clean tech VC. And I would say that we've probably also been the most consistent, as we've, again, supported the market since its beginnings and through its various cycles of development. Next slide, please. In line with the development of the market and our own activity and policy goals, what we understand as climate and environmental impact or sustainability has evolved over the past years. As mentioned by Paula earlier, climate and environment really isn't a sector or industry in itself, but rather an aggregation of overlapping verticals and themes that have high climate and environmental impact and value. As such, our mandate and investment scope is again very broad and covers all key verticals from energy to water and natural resources management, just to name a few. We've notably also, again, helped to champion the emergence of new teams and investment themes, and we're really looked at as a major cornerstone anchor investor that has a strong catalytic effect with other potential investors who value our due diligence, structuring input, and also our engagement as a long-term and stable partner. We're also active, as you know, across the funding continuum from proof of concept to growth and expansion capital, and we can thus support the financing and development of game-changing innovation needed for the future, all the way up to the commercial expansion of companies that have proven climate and environmental solutions that can be deployed as of tomorrow. Given also our identity and mission, we have a clear European focus, and currently, over 75% of our fund commitments are earmarked for investment into Europe. Finally, one last and important point worth highlighting, which was also mentioned earlier, is that we really embed impact in all of our fund investments. We've been one of the early promoters of impact measurement, having developed our own methodology and framework, which we're now rolling out to all of the climate and environmental funds that we work with. Our investment volumes in climate and environmental VC funds have increased in recent years and are set to grow exponentially in line with our ambition to really support our policy goals. But before moving to our objectives, I think it is worth pausing a moment to take a look at the current state of the climate environmental VC market. Next slide, please. So a first wave of clean tech investors appeared on the market in the 2000s. I think many of you know that for a number of reasons, these first investors fared poorly. The market at the time was still largely immature and ill prepared for the VC model. Technologies were, still in early stages of development, quite costly, difficult to scale. Investors at the time didn't have a lot of experience, and there was a general lack of corporate interest, I would say, in sustainability, which could, ensure business development and exit opportunities for the clean tech innovations that were coming to market. As a consequence, a few of these early investors survived, and those that did have quite a few battle scars, I would say. And the climate environmental investor landscape has until very recently remained quite sparse. Climate tech, however, has matured significantly since the first clean tech 1.0 boom. And today, battery, wind, or solar energy technologies have really achieved scale to provide power at costs that we can say are equal and even below fossil fuel energy. Nearly all climate-related technologies that are currently in existence today are actually positioned to achieve scale within the next 10 years. Corporates, as we know, are also integrating and acquiring technologies and businesses to comply with ever-increasing climate environmental regulations and really ensure the sustainability and viability of their business models. So sustainability is finally garnering the attention it deserves, and this momentum is translating into growing levels of investment, enhanced valuations for clean tech companies, and more M&A and IPO activity. This development and maturation of the market is also reflected in its performance. And as you can see at the bottom of this slide, had you invested in a clean tech company during the 2005-2009 period, you were probably very lucky if you managed to recover your investment. 10 years later, the performance of clean tech investments is not only positive, but in the double-digit figures, which reflects, I would say, the radical change in market dynamics and, again, the magnitude of the need and opportunity. So the market today is really ready and ripe for investment, and as a result, we're seeing a new generation of VC and PE investors emerge. Next slide, please. Generally speaking, the climate environmental VC ecosystem is underdeveloped, really across themes, sectors, stages of company development, and geographies. Again, we are, however, seeing a new generation of VC investors coming into the market. Many of these teams are spinning out of existing VC PE firms, corporate VCs, or industry operators. They're also leveraging existing, large asset management platforms. And I would say that many of them are bringing a wealth of relevant skill sets and experience to the ecosystem. Likewise, and in parallel, we're seeing a growing interest from the wider VC tech community, and sustainability is certainly becoming more mainstream and also becoming a prominent investment theme together with ESG as part of broader investment strategies. So the first wave of clean tech funds were more generalist in scope, but there is certainly now a shift towards more specialized funds and managers by vertical, which we think is positive. It's really contributing to build up a specialized VC ecosystem of managers along strategic verticals that can provide, relevant sector expertise and value add to entrepreneurs and companies in addition to capital. I would say that this is particularly important in early stages of technological development or industrial scaling, as well as in highly regulated sectors. So although all verticals are still characterized, again, by a limited number of investors, certain sectors such as the agri-food tech space, energy, smart cities, or mobility are proving to be more dynamic with an increasing number of funds having been raised over the past couple of years or in fundraising targeting these sectors. Despite their strategic and economic importance, there's other verticals such as water or the blue economy that are still very embryonic and surprisingly overlooked by investors, and as a consequence, they require reinforced support, certainly by public institutions such as ourselves, with dedicated, programs. In terms of stages of development, the funding gap really affects the whole value chain from early stage innovation to companies seeking growth and expansion. This notwithstanding, there are certain segments that are particularly underserved, And this is notably the case of companies requiring product or industrial scaling or focusing on deep or hard tech, where technology and industrial risk together with capital intensity tends to be higher. And although the fundraising environment has certainly improved, I would say that fund sizes, overall continue to remain a little suboptimal, which limits the ability of funds to give their portfolio companies, the capital runway that they need in the absence of more syndicate partners and co-investors. Finally, in terms of geographic scope, most funds are multi-country, pan-European, or global, as climate environment is really global by definition and knows no borders. And the majority of fund initiatives are presently coming out of Western Europe, although we are starting to see more proposals from other geographic markets. Next slide, please. So given this landscape, we've established a number of strategic objectives for our intervention in climate environmental impact over the next few years. One of our immediate goals, of course, is to significantly ramp up again our investment activity. We expect to commit an additional 2 billion euros by 2025 in climate and environmental VC funds. Alongside this objective, we're also striving to build, a well-functioning European climate and environmental VC ecosystem, which really has, the breadth and depth necessary to support European SMEs in different strategic policy areas and geographies and through all stages of development. As a consequence, we also, are having an enhanced role, again, as anchor investors, supporting new and emerging teams and really making strong and meaningful commitments to the funds we back to assist in their launch. Last but not least, again, we're really striving to maximize the impact of our investments, not only by providing capital, but also by introducing impact measurement in all the funds we work with, and also aligning fund managers' economic incentives with impact achievement and performance. We ourselves are also reporting on our climate and environmental targets, as mentioned, to our stakeholders, notably through our Climate Action Environmental Sustainability Framework, which our colleague Marilyn will explain later. Next slide, please. So at the start of 2020, we devised a 5-year strategy to deliver on our climate and environmental objectives in VC, and I'm pleased to say that we're not only on track, but actually ahead of plan. So within 3 years, we've tripled our investment into dedicated climate and environmental VC funds. And by the end of 2023, we expect to have a portfolio of 70 active VC fund commitments. Of the funds we've backed since 2020, over 90% correspond to first-time or emerging teams, as you can see on the slide, and 70% constitute new relationships for the EIF. As we also mentioned, and contrary to the first clean tech generation, we are seeing more thematic funds. And these represent, on average, over 60% of our investments since 2020. Although I would like to insist that general interest funds are equally important, particularly in the tech transfer or later stage segments of the market. The increased fund specialization has enabled us to extend our coverage of major thematic verticals, including the blue economy, water tech, circular economy, and as these weren't previously represented in our portfolio through dedicated specialized funds. We've also supported funds in new geographies such as Spain, Portugal, Ireland, to name a few, and the vast majority of these funds are pan-European in scope, but their location in specific geographies does allow us to enhance coverage of their home markets. There's still, however, a lot more to do, and as a consequence, our investment activities will continue to ramp up. And in 2023, and based on our advanced pipeline, we expect to surpass the 600 million euro threshold in new commitments. And we'll continue, of course, to extend our reach across strategic and underserved verticals and geographies, as well as paying particular attention, to the funding availability at different stages of company development. So next slide, please. So to finish the overview of the VC market, I do think it's important to again emphasize that the climate and environmental VC investments are not only being carried out by dedicated or specialized players, but also and importantly by VC funds with more generalist impact or broader tech strategies. Climate and environmental impact is closely tied to social impact, and it's clear that the most vulnerable will also be suffering the greatest from the challenges and effects of climate change. As a consequence, many social impact investment funds are also contemplating, to one extent or another, investment into climate and environmental impact. Likewise, last year, close to half of the digital or disruptive tech funds that we backed had identified climate and environment as one of their investment themes, and additionally indicated that they expected to invest between 5 to 30% of their fund into companies that were considered eligible under our climate action environmental sustainability framework. This year, some are already stating that they would target to invest up to 40%. Within climate environmental focused funds, this percentage is obviously higher and typically above 60%, and on average, between 75 to 80%, although it can differ depending on the strategy. Finally, as sustainability goes mainstream, it's also increasingly important to provide for greater transparency, of course, on the degree of sustainability of financing products. The EU's Sustainable Finance Disclosure Regulation raises the bar for investment products by, setting minimum disclosure standards. And within our climate environmental activities, we are increasingly seeing funds applying to Article 9 under SFDR, as compared to Article 8, which seek to promote environmental or social characteristics, as well as good governance practices. Article 9 funds, deliberately pursue a positive impact on society through sustainable investment and really have a non-financial objectives at the core of their strategy. They're, then considered, a darker shade of green. Being an Article 9 fund, however, is not a prerequisite for our investment, and we evaluate the fund strategy independently of its classification. We also understand that a number of fund managers don't feel prepared yet to register as Article 9, given the associated requirements, and are also waiting to have more clarity before making this important step. So that's it for me. Over to you, Cindy. We'll speak about what we're seeing in the PE market.
Adelaide. Good morning, everyone. I'm Cindy Daniel. I work for EIF Lower Mid-Market team, focusing on private equity funds in Europe. So first, a quick overview of LMM activity. If we can move to the next slide, please. Yeah, thanks. So looking at our activity, we've been active in the private equity market for the past 20 years, and we currently invest around 1.8 billion a year in the European lower mid-market. We screen around 200 deals a year, providing us with quite a unique knowledge of the market. And we are actively participating to the evolution of private equity investment in climate and environment. So if we move to the next slide, you will see what we believe have been the main evolution and is the current state of the climate and environment market in private equity in Europe. So it's quite similar to the slide that Adelaide has just presented, focusing on VC, but the main issues and challenges are the same for both segments, for VC and PE. Private equity, climate environment is still a nascent market developed by new teams that are spinning out of big corporates or large established asset managers, as per for the VC segment. All sectors and verticals are still lacking capital, even if some are more advanced than others. So would be the ones that are more advanced would be the same that Adelaide mentioned: energy efficiency, mobility. The ones that are less advanced would be blue economy, circular economy. Looking at portfolio companies, there is a funding gap, mainly for innovative scale-ups, but also, that's more specific to PE, for capex intensive companies, as they've been lagging behind and being overlooked by private equity funds, even when they're not in climate and environment subsectors. On a geographical level, we see the same trends in PEs and in VC. The investors active in climate and environment are mainly based in Western Europe, France, Italy, the Nordics, and some of them have a pan-European approach. So clearly, same challenges here than in VC, quite similar market. If we go to the next slide, please. So looking at what we do and where we see the different subsegments of the market. In private equity, we see more and more dedicated climate and environment funds. So it would be funds that have specialized thematic strategy focusing on one of the subsectors. These funds typically will be Article 9, could be Article 8 as well, due to the challenges that Adelaide has mentioned just before. And focusing on EIF internal C&ES framework, they will have a high allocation to this framework, above 60% and on average 80%. What we see as well is the emergence of thematic funds, but compared to the one that I mentioned just before, it would be funds that have identified a number of thematics. So often they are spinning out of more generalist manager, and they've identified 3-4 themes. One of them will be related to climate and environment. These funds will typically be Article 8, and the C&ES contribution will be between 20 and 40. What we do see as well are that generalist funds can be active in this segment, especially as some of them either have identified the climate and environment as a sector of great interest, of the opportunistically have been doing deals in this segment in the past, so they are willing to commit to invest in one or two investments in these sectors. These funds will be typically Article 8 and will have a lower allocation to the C&ES EIF framework, so between 5 and 15% depending of the fund strategy and the manager experience. If we move to the next slide, please. So that slide is a bit outside our EIF C&ES framework. It's really on the decarbonization that private equity funds and private equity managers can do. There is a strong interest in the market in decarbonization of portfolio companies. You, as shareholders, are well placed to help transition portfolio companies towards more sustainable activities and to help decrease the greenhouse gas emissions of the portfolio company. So that's what we already see in the market, that private equity managers are monitoring greenhouse gas emissions of the portfolio companies level, taking into account scope 1, 2, 3, that they are really having challenging decarbonization plans for these portfolio companies, and they link this plan and on the achievement of decarbonization targets to their carried interest allocation. So as I said, that's outside our C&ES framework, but it's an interesting trend in the market that we thought would be good to present to you today. And on this, I'll hand over to Priscilla.
Thank you, Cindy, and good morning, everyone. So my name is Priscilla Schnepper. I work in the debt funds division of the EIF, and we will now give a closer look at senior private credit. If we could move to the next slide, please. So on this slide, we see a general overview of the senior private credit market over the past years. Basically, EIF's activity. EIF has been at the forefront since the coming up of the asset class in the early 2010s. Until now, we have signed 2.8 billion into more than 60 funds, supporting more than 3,000 companies, mainly SMEs and small mid-caps, as was also mentioned, is the specific focus of the EIF. We work with first-time emerging and established managers, and the type of strategies we generally see is the, let's say, classic senior loans, unitranche, and then also asset-based financing. Now we would like to move to the next slide and show a trend that we are observing now in the market and which is becoming more and more important, a trend and a move towards sustainability and impact. While historically debt funds were more generalist, we now see a large share of debt funds actually moving towards thematic, specifically climate and climate impact. We see two types of funds in the pipeline. It is, well, where does this move come from? It comes in part from the upcoming EU regulation, which raised awareness of this important and burning topic, which needs to be worked on. And at the same time, also EIF really taking the forefront, scouting and promoting sustainable activity. In this sense, we see two types of developments, as mentioned, thematic funds, which actually do focus on investments that help on the promote a climate objective, that help financing the climate transition and have a really sustainable objective in the fund. At the same time, what we also see is for generalist funds, a move or a change in mindset to incorporate sustainability, like, for example, include ESG as one of the risk analysis into the investment process, or also have tangible sustainability targets, even though maybe smaller in size or less prominent than in thematic funds. But I think the important message is really to say we see a strong move towards a new mindset. And maybe last, and to see the last graph, 1/3 of the pipeline right now is in the thematic area. Maybe we can move to the next slide. So what do we see in terms of classifications, and also reflecting a bit what was said by the colleagues previously? So we have on one hand, we do of course look at the SFDR. Its objective initially was to promote or to have disclosure requirements to reduce information asymmetries. And now we can kind of see a different strategy reflected by the SFDR article that is chosen by the different fund managers. So while, for example, an Article 8 includes environmental and ESG criteria into the investment process, basically a promotion of environmental and social characteristics, under the Article 9, fund managers are obliged to have a sustainable investment target with basically all of the investments contributing to this target. Here you can see an extract from the regulation. I'm not going there in detail, but basically to say it can be an environmental or a social target. Here we will more focus on the environmental part. And on the other hand, we do see impact funds. Often there is an overlap between impact funds and SFDR Article 9 funds, even though this is not required, because let's say SFDR is more from a reporting perspective, and an impact fund will have a real intentionality, additionality, and which then can also be measured and often linked to the performance fee. Linking this whole now to the CANDS, so what we would often see is that funds with an environmental objective under the SFDR and an impact fund with an environmental impact theme would often have a higher target of climate action, environmental sustainability. Now, moving to the next slide, we can see a bit more how this can actually be implemented for a private debt fund. So we can either look at what we call sustainability linked loans or sustainable loans. And both of them can actually be in an impact fund or in a fund that follows a more generalistic strategy or does more ESG investing. So on the sustainability linked loan side, what do we see? It's often a general purpose loan, but with an impact roadmap attached. So it's a company that would like to change its ESG performance or even move towards a more sustainable target. It depends on to which level the fund or how ambitious the fund target is. And then often we would see that these KPIs would be linked to a margin budget in order to have an incentive for the borrower to actually align with the specific KPIs. And they can then also be linked to a target at the level of the fund. Sustainable loans, on the other hand, are loans whose proceeds are directly used for environmental, climate, or also social benefits via one, the company's economic activity, or via the purpose of the financing. So, and here we have examples that can be green loans, social loans, or a combination of both. And what can be interesting is also funds can combine these two types of investments. So basically to say that you can, for example, have a sustainable loan that would be, for example, for supporting a renewable energy project, while at the same time linking it to an impact roadmap. Now we would move to the next slide, where we can see a bit, or where we look a bit closer at what we have seen in the private debt space for the climate action and environmental sustainability criteria. A bit reflecting what was also said before, we can see climate action environmental sustainability criteria respected in generalist funds, as well as, and obviously even more, in climate thematic and impact funds. So on the right hand side, we can see the thematics focused on by the thematic funds, which usually have 60 to 100% respecting the climate action environmental criteria. So basically meaning that most of the portfolio are sustainable loans with the objective to support thematics that contribute to a sustainable change, like, for example, in the mobility and transport sector, in the energy sector, in the industrial decarbonization sector, in the agriculture, to have, for example, sustainable loans, also in the blue economy. And on the left hand side, we can see that generalist funds can also have a small share of these sustainable loans, which can range from 0 to 30%. And now we would go to the last slide, where we can see some concrete examples of strategies that we see in the private debt space. So meaning the first one, and coming back on the definitions. So here we have either financing provided to a company that is active in a climate sector, like, for example, a renewable energy developer, a climate tech developer providing new solutions for energy savings, green mobility measures, sustainable agriculture, etc. So here we have a loan issued to a company that is sustainable or active in a sustainable business. And the second one is by financing a specific investment that will have a positive impact on the environment, like, for example, a generalist company carrying out an investment to increase energy efficiency, or emitting less CO2, or reducing waste. And on the right-hand side, we can see a few concrete examples, like, for example, the first fund providing asset-backed financing, which helps company to reduce their, or to improve their energy efficiency. Then on the second fund, it is the idea of to support companies that themselves have solutions. When clients use them, they will reduce their energy emissions. So basically the idea of avoided emissions. And in the third case, we actually have a fund that is a mixture, or that has a mixture of an environmental objective and a social objective, with also a high share of sustainable loans. And with this, we can move on. And at this stage, we would actually have a question, which is for your next fund, would you consider it to be an SFDR Article 8, 9, or none of the above? The answers coming in. Okay, we see a higher share. Still Article 8. We see that many participants actually do look into this topic and want to integrate ESG, or even have a sustainable objective for upcoming funds, which is an encouraging and interesting result, I would say. Thank you. I think with this we can move on, and I would head over to Marilyn.
Hello, everyone. I hope you can hear me well. My name is Marilyn Höratz-Beasley, and I'm a Senior Climate Officer, part of the IAF Strategy and Business Development Department. I will take you through briefly, as mentioned, the IAF's Climate, Environmental, Sustainability Finance Principles, the origins of our framework, and provide you hopefully with some useful insights on the criteria and reporting. If I can ask the next slide, please. Thank you. You have heard from my colleagues about the InvestEU equity products, its thematic target areas, and also about our institutional framework and how we see the sustainable finance market today. Although EIF is not a bank, as part of the EIB Group, as you heard from Igne, we adopted in 2020 something called the EIB Group Climate Bank Roadmap. As the name suggests, it's a strategic document that frames our institutional ambitions on, say, sustainable finance until 2025 and beyond. But it goes much further than just climate finance. It sets also principles for risk management, for just transition goals, and also how we define Paris alignment for our operations. It also commits us to start tracking climate finance based on the principles of the EU taxonomy regulation as this gets developed over time. You see on this slide here an illustration what this means for our financing activities and how the InvestEU fits into all of this. As a minimum, all operations that are financed with the backing of EIF have to follow our Paris alignment framework. In simplified terms, this means a widened set of investment restrictions. The ones of you who have cooperated already longer with us know that we also had sector restrictions in place before 2020. However, with the Climate Bank Roadmap, we added a widened set of new activity-based restrictions that cover more explicitly fossil fuel-related investments and high-emitting industries, such as chemical or cement production, but also conventional aviation. All of these restrictions and other contractual requirements that we are implementing as part of our ESG principles are aimed to ensure that the operations we support do not harm the environment nor other ethical objectives. On top of these institutional restrictions, the mandators who trust us with funding, mostly stemming from the public resources, might have additional regulatory restrictions or also expectations in terms of thematic policy objectives. This is also the case for the InvestEU mandate from the European Commission. And as I said, we are not a bank. We do not issue bonds, and therefore we really rely on the trust and backing of our shareholders and mandators when rolling out these financial instruments to you. And within this set of eligible activities that the product or mandate might target, you will find our green finance criteria, the EIF, CA, and ES criteria. Next slide, please. Thank you. The term EIF green finance or climate criteria is often just used as a shorthand. The official long name is Climate Action and Environmental Sustainability. As an EU institution, we also like to use, of course, a lot of abbreviations. Therefore, you will hear me talking about CA and ES or even KS criteria. As already alluded, the CA and ES criteria is inspired by the EU taxonomy. I say inspired as it is not fully taxonomy aligned yet, and any fund manager implementing it in their operations should not report their taxonomy alignment ratios purely based on our criteria. This being said, we have integrated elements from the taxonomy framework into ours and will continue working on this also going forward. We have already started tracking the financing volumes according to the classification of the 6 taxonomy objectives. This you can see on the left side. The 2 climate objectives, climate change mitigation and climate change adaptation, and the 4 environmental objectives, circular economy, pollution prevention, control, protection of water, marine resources, and biodiversity and ecosystems. And this is also where the abbreviation CA and ES comes from. We have also integrated a large part of the substantial contribution criteria into our climate section of the guidelines. The ones of you familiar with taxonomy will know that in order for an activity to be considered fully taxonomy aligned, it would need to comply simultaneously with the substantial contribution criteria set for the taxonomy objectives and do no significant harm to any of the other 5 objectives. And in addition, minimum safeguards would need to be ensured through the implementation of procedures by the undertaking. As the taxonomy framework is not yet finalized, alternative criteria is used in EIF in line with the EIB climate finance criteria for activities that are, for example, not yet covered by the taxonomy or where we considered it more appropriate for the time being. These examples would be, for example, green data-driven solutions or ICT and RTI. This alignment of the criteria with the EIB is very important for us, as under the Group Climate Bank Roadmap, we have group-level targets and commitments. And therefore, one set of climate criteria is used across all of the debt and equity products. Next slide, please. So today, as I said, we do in fact cover all of the taxonomy objectives, meaning that we do not only support and encourage climate-related activities, but also nature and biodiversity. This here is not a full list, but a snapshot of the activities that we have seen as relevant for the equity market. Mitigation is likely the most known to all of you. Here you would find activities and investments supporting renewable energy efficiency technologies, green mobility, and a wide range of clean tech and ICT solutions. Under adaptation, you will see activities increasing resilience against the unfortunate effects of the changing climate that we are already witnessing today, and also monitoring extreme weather events or developing new drought-resistant crops. Some satellite technologies or big data-related solutions could also be captured here. Under protection of water and marine resources, we have, for example, water savings and efficiency technologies and investments. And the circular economy can support a wide range of activities and products supporting reuse, recycling, repurposing, but also waste management. Pollution prevention and control covers all types of pollutions that are harmful for the environment. And biodiversity and ecosystem captures activities from organic agriculture to sustainable forestry, but also sustainable materials and alternative proteins. And I think now we have another quiz, if I'm not mistaken. Yes. So the first question would be, are you taking into account the EU taxonomy criteria in your investment selection process? Now that you have heard a little bit also what we are doing. So far, the replies are very positive. Still moving a bit. Great. It seems that quite a large part of the respondents are actually taking into account taxonomy. Great. Maybe we move on to the next question because I have actually 2 questions to you. And the second question would be, in what area do you expect most of your climate action, environmental sustainability investments to be? And this is now listed according to the 6 taxonomy objectives, or you can also choose none of the above if you somehow see that this doesn't really fit your activities. Great to see that climate mitigation is not the only activity anymore, which is, I think, also what we see from the results from the markets. Moving a little bit. Perfect. I think we can move on. That's quite interesting. I'm happy to see circular economy and also biodiversity activities there, because these are equally as important as climate finance. Maybe if I can have the slides back. Super. Now, after you heard a little bit what the criteria is about and where it comes from, a few words about how we are determining the climate action, environmental sustainability contribution in our operations. I have to mention a small caveat that for infrastructure funds, the procedure is slightly different. So my presentation in general today is focusing really more on the venture capital private equity funds that are non-infrastructure specific, and also debt funds. So the Climate Bank roadmap and other mandates such as InvestEU oblige us to track and report green financing already at the commitment level with our funds. And what you see on the left side of the slide, this is what we call tracking. We fully understand that this can be oftentimes challenging to estimate precisely, as we are operating in a fully delegated model with our fund managers and in a market and regulatory environment that is changing. That is also one of the reasons we put so much emphasis on our climate criteria and ask for a contractual commitment with you. The commitment estimate will be done by the fund, and this will be, let's say, assessed by us also against your past track record, your previous experience, your available pipeline, and in general, existing products and motivation regarding CA&ES activities. This doesn't mean that we only invest into funds that already are very experienced. We do want to encourage also new funds really starting to targeting these activities. We do expect the commitment that the funds take to be credible and achievable. So you shouldn't overcommit, but we hope that you will also not undercommit. And we will be monitoring the achievement of the target at the end of the investment period. It will, however, not lead to an event of default or financial penalties when not met. But as I said, as we have also our own institutional targets and commitments that we're undertaking, we will be monitoring and we do hope that fund managers will reach out to us if they have any problems understanding the criteria or finding the pipeline. I will come back a bit later on the reporting, but for the moment, next slide, please. If you don't know yet, or if you haven't yet seen our CA&ES guidelines, it's also published on our website. And the reference when committing with us will also be in your contractual document. It's published on the publications, so you can also search for it. And this document, for the moment, is from the version is from 2022. In case there will be further developments or updates to the framework, we will also update the document on our website. It will be clearly indicated if there is a new version. It doesn't mean that you are automatically obliged or used the new updated version of the document. So whatever is agreed with you in the contract is, of course, the one that is ultimately valid. Next slide, please. This is a little bit a snapshot into how the guidelines look like. So there is a little bit of a description in the beginning of how we are implementing the guidelines. And maybe one important thing to note here that there are two ways for an investment to count for EIF, CA and ES targets. A final recipient, an investing company, economic activity can fall within at least one of the criteria listed in our guidelines. This, for example, would be a producer of a new renewable energy or energy efficiency technology, water saving, pollution prevention technology, or also company dedicated to advising or designing climate mitigation projects. And the other option is that the investment targets at least one of the activities listed in EIF guidelines. And regardless of the economic activity of the company itself, as long as, of course, the company doesn't fall under any of the restricted categories. The last case would be applicable to debt funds, where the investment loan can be clearly linked to the CA and ES criteria. Next slide, please. This is just, again, a snapshot of the document, how it looks like. It is built, as I said, on the 6 taxonomy objectives. So you will see 6 bold headlines. I've only included 3 of them here. And you will notice also that in the climate section in the beginning, we have some climate impact indicators, green results indicators, as we call them. These are not, you will not find them for all activities. This is used for the moment only for some climate specific activities. And this is also for our institutional reporting or mandate reporting obligations. We have also, we're working on tools to help you assess these indicators, and we are collecting them on a best effort basis, if possible. And move to the next slide, please. I've included actually altogether 7 examples, which I thought could be interesting to go through. Here on the first slide, you will find one of the criteria, which is energy efficiency technologies. And it's related more to equipment and concrete products. Here one can find both more traditional manufacturing companies, not necessarily considered highly innovative, but also quite technology-oriented companies. The criteria is quite self-explanatory. There are sometimes certain values to be met in order to qualify, such as the doors and windows. And this could fit for door and window manufacturers or certain high energy efficiency rated appliance producers, like heat pumps, for example. A company developing smart systems for heating, monitoring and controlling, or a manufacturer of thermostats. Next slide. We have more than one category where you can classify technologies. And here is, I wouldn't want to say a bit of a catch-all, but there is definitely opportunities to capture here technologies and solutions that are not fitting on the other categories. And we call it this other low carbon technologies. It covers technologies, technological innovations, and for example, a company that would develop a carbon capture and storage system, a company manufacturing hybrid electric propulsion systems for aircrafts, or electric battery-powered forklifts. Here we also recognize product components that are essential for making the final product substantially really contributing, substantially reducing greenhouse gas emissions or energy efficiency. And this is even if the product itself is not manufactured, for example, by the same producer. But this has to be an essential component linked really to the energy consumption and efficiency, and not simply a nut or bolt that holds the machinery together. We have seen actually 2 recent examples here, which we considered relevant. One was related to a really machine component used specifically in the textile industry, and the other was a new type of design of ventilator blades that really reduces substantially the energy consumption of the final ventilator. Please also just note that, like with any criteria, you would need to keep certain files on record to evidence this assessment. For example, a study comparing other best available technologies with the product, or a business plan. And also to note, we do not require any specific greenhouse gas assessment evidencing for products that are really clearly by design zero emitting, such as battery technologies. Next slide, please. We included here green data-driven solutions. This is something we see a lot. Anything to do with green data, digital, and actually I forgot to mention earlier that under all of the 6 categories, we have green data-driven solution, ICT solutions, and also RDI and technical assistance if it would be really dedicated to one of those taxonomy objectives. So you can find these activities under all of the objectives. This one here is, for example, related more to climate mitigation. And as an example, we could give an artificial intelligence-based platform for monitoring and controlling energy efficiency in buildings, or a company providing software as a service solutions for energy monitoring in data centers. Next slide. Also included circular economy example, as and I was very happy, as I said, to see also in your replies that one of the thematic focus is circular economy. And this is quite a wide criteria, which is related to production processes and technology, allowing the transition to circular economy in existing industries, manufacture, but also agriculture. For example, you could find here companies developing a process for textile recycling, or recycling used paper to produce then paper bags. Debt funds could finance here also more traditional manufacturing companies that are replacing their production facilities, production lines that would allow them significantly to reduce raw material use. Next slide. And another circular economy example, which is what we have seen also a lot, is product as a service, aimed at reuse and really sharing models and enabling, therefore, the circular economy strategies. And here, for example, we have seen bike sharing services, an online platform aimed at reducing food waste by connecting local restaurants and shops with consumers, and linked to actually also to vulnerable people and charities. So it has also a very strong social aspect to it. And many of you might have a printer in their office that is actually rented and serviced from a company and not owned by you. So these would also be examples of products as a service. Next slide. Yes, and as I said, we have also RDI. So this example is RDI in pollution prevention and control. You will notice the ones listening that are more familiar with the taxonomy criteria, that our RDI criteria today is rather short and snappy. We do say that the application has to have potential to substantially prevent and reduce pollutant emissions, but today we're not requesting evidencing based on different technology readiness levels. As we are dealing mostly with startups and SMEs, we are not also requesting any dedicated evidencing of full life cycle assessment. Here, for example, under pollution, we could mention air pollution abatement technologies for air purification. but we just a caveat that we do count pollutants that relate to climate, and therefore air purifiers that are only designed to fighting, for example, COVID or other similar diseases would not be counted here. So it has to have also really an environmental sustainability aspect to it. And all the pollutants are covered, otherwise air quality, noise reduction, water, marine, soil pollution is also very important that we see today. Next slide, please. I think that's the last example, which comes from the bioeconomy sector, is investment in non-traditional crops and alternative proteins. That's quite self-explanatory as well. We also cover sustainable organic farming, but here the emphasis is really on innovation. For example, a company developing insect protein-based dog food, but also biopesticides producers could be covered in general under the bioeconomy objectives, of course. Next slide, please. Yeah, and my last part of the presentation will focus a little bit on the reporting template and reporting themselves. I think some of the questions that we also received in advance, they were concerned about the complication or perceived complication about the reporting, and just to ensure you that we are actually requesting only one-off reporting of the climate activity. And I start here with the debt funds. The reporting template here follows more our debt financing template model, and the CNES activity will be mandatory to insert in a few fields that have now been newly added to the tab, which is called New Final Recipient Transaction. You will also see that the input here is based on certain codes, and these codes, the numbering, they follow the same list of the climate action and environmental sustainability criteria that I showed you before and that is uploaded to our website. And you'll also find the same list in the dictionary tab, which is here on the lower part of the slide. These slides are just illustrative. The numbering of the codes here will change somewhat to really reflect what you see in the guidelines. But this is to show that the reporting is reported to us at the same time when you first report the InvestEU loan, together with complementing the other information that we request. Next slide, please. For the venture capital and private equity funds, we have designed the reporting within what is called the new InvestEU form that you are probably all familiar with. And it follows a slightly different design, but still should be hopefully very user-friendly. As normal, the starting point of the InvestEU form is that you would have to select your fund, and also you would have to select the company that you're reporting and just click to generate the form. The basis, again, of course, as said, is our own CNES guidelines, but the list follows a little bit of a different structure. Next slide, please. You can see here that contrary to the debt funds reporting, here we have drop-down lists and not codes. And also you will notice that some of the names, they are slightly different. So we don't start with the 6 taxonomy objectives of mitigation adaptation, but rather more thematic headlines. We thought about it quite a long time and discussed also with our our colleagues that you have heard presenting here today, and we came to the conclusion that for venture capital and for private equity funds, the thematics at the starting point would be more simpler and easier in a way to, if they could see certain thematic objectives. So this is why the design of the template is slightly different, but underlying we have all the same criteria as you see also in the CA&ES list. And you will even notice that some activities might be listed 2 or even 3 times under different thematic headlines. This is also an illustrative example. We are currently working on updating the list slightly, but the basic will be the same. Next slide, please, which I think should be even my last one. Yes, so you will see here that there are currently 4 options for you to select, which will pop up also the description of the eligibility criteria. And some of you that have not, that are funds that are older in our portfolio that have not yet maybe so familiar with our criteria, also you will be able to read the criteria here and the definitions, what we cover. Yeah, I think next slide, please. I'm slowly running out of time. Yeah, and that is just a snapshot here of the reporting template. As I mentioned, it follows different headlines and which are more thematic, but underneath those headlines are all the same EIF CA&ES criteria that you also find on our website. So yeah, that's it. I think, Adelaide, I give the floor back to you. Thank you.
Thanks, Marilyn, for your very clear, and I believe we have one last poll popping up. Okay, so here goes the question. If you were to allocate a share of your next fund to CAES as per EIF's definition, what percentage of invested amounts would climate action and environmental sustainability represent? And the votes are coming in. It's still moving slightly. Let's give it a few more seconds. I wanted to say that it was stabilizing somewhat, but I still see some bars increasing or decreasing. Okay, well, overall, it seems like we can conclude that most of the attendants expect that over 50% of their investments will qualify for CAS. And there is about 1/3 of the attendees here that think that less than 25%. But again, I think overall a very good representation. So this brings us to the end of our presentation, and I'd like to thank Marilyn particularly for her very clear and structured overview of our climate action environmental sustainability framework. Before moving to our general Q&A, we have received one question for you, Marilyn, from the chat that ties to the CAS framework, and I wanted to bring it up straight away. So the question is, does reporting on CAS a target have to be at the time of investing in a portfolio company? And I know you've touched upon this, or at the time of exit. And this is also in order to take into account that a fund manager might be able to develop or shape a portfolio company with regards to its CAS alignment, and I guess maybe pivot its business or strategy towards climate action, environmental sustainability.
Thank you for the question. The short answer is it is at time of the commitment when also the fund is investing in the portfolio company. Just to maybe say that for startups, indeed, we do take into account also business plans. Of course, there might be really a technology that is still to be developed in the early stages. So there, let's say, to estimate volumes, future use of the technology and everything, it is not really just only on the past experience. It can also take into account business plans, but it is really at the time of the investment. I don't know if my colleagues want to complement, otherwise we can move to the...
I think the answer is pretty clear. Maybe moving now to Paula from our mandate management team. One question we received ahead of registration is whether the InvestEU program has been designed in a way to support even more fund managers if their funds comply with the SFDR Article 9 requirements. If so, what are the additional incentives or supporting terms offered by InvestEU?
So the answer is no. We don't have any requirement in the InvestEU guarantee agreement that makes reference to SFDR. I guess that if we find a fund targeting climate and environmental solutions and accepts our impact measurement methodology, and then it's classified as Article 6, it might raise our eyebrows, and then we would try to understand why. But I mean, it's not a requirement itself from the regulation. I don't know if you colleagues from the front office want to complement.
Well, maybe adding to your comments, Paula, what is true is under InvestEU, if a fund does target more than one area under climate environmental sustainability or qualifies, for example, as a social impact fund, there are certain, I would say, extra advantages or benefits in terms of, the commitments we can make. If you can elaborate on that.
Yes, exactly. So the size of the operation, no, we were talking about the maximum ticket and the participation of the EIF in the fund. So normally the maximum participation is 25%, but there are some exceptions depending on the type of fund. So exactly, in the case that a fund is targeting more than 75% of the target areas, we can go up to 50%. In the case of impact-driven enterprises, for example, up to 75%. Thanks for the note.
Great, thanks, Paula.
If I can complement as well, for first-time team, we can go up to 50%.
Indeed, yeah. Cindy, don't go away. I have a question for you, actually. So one question we got on private equity funds is, what can private equity funds do towards investing in a sustainable future? Which areas in particular should they be paying increased attention to, do you think?
Yeah. So as we touched upon during the presentation, there are two main trends for companies, either to be enablers, so really being active in sustainability, or you have companies that are transitioning. So for a private equity fund, it would be the two-way to be investing in a sustainable future, would be either to invest in these enablers or to help, like the brown companies being more green and to help them transition. What would be important, I would say, for a manager would be really to put a rigorous focus on sustainability at all stages of his process. So from DD to the value creation phase, it's very important that it's at the core of the process.
Great, thanks, Cindy. Another question we got, and that I'm happy to take, is one regarding the energy transition and hardware technologies. So the question is, energy transition is a lot about bringing new hardware technologies to commercial stage. What are the EIF and the EIB's efforts towards supporting hardware innovation? So as we mentioned during our presentation, we're certainly acutely aware of the funding shortfall in this segment. And as a consequence, we're really supporting new funds and managers that are targeting the clean tech scaling gap and can provide that critical funding. We're acting as an anchor investor also to these funds, making really large commitments that we think will allow them to more optimally execute on their strategy, which, as we said, is slightly more capital intensive. So just as an example, last year we supported 5 climate and environmental VC funds, which are addressing what we would call the growth financing gap. And of these 5, 4 were actually partially focusing on the scaling of energy hardware technologies. This year, we expect to back at least 3 more funds that are fully or partially focused on scaling clean and energy hardware or deep tech technologies. I think it's also important to mention that our mandates, also want to address this funding gap. And so apart from InvestEU, which we know has a dedicated climate and environmental window, as well as growth financing available, we also have new mandates under implementation or that have just been launched, which are seeking to close the gap. 2 mandates that I think I should certainly mention and that you'll hear more about are Repower EU, which is a mandate specifically designed to accelerate the energy transition. And we presently have 1 billion to deploy over the next 5 years for VC financing of clean and energy tech innovation, and another 1 billion for private equity financing also to support the energy transition. Another mandate, which is focusing on bridging the European growth financing gap, is ETSI, so the European Tech Champions Initiative. And this mandate is actually being promoted by a number of EU member states, which have already indicated their support. At present, France and Germany, with other member states to soon join. We've secured 2 billion euros in resources, and we expect it'll go beyond 3 billion as, again, other countries join. And the investment strategy here is really on supporting funds that are targeting an investment capacity of at least 1 billion euros each, and investing in late-stage growth venture companies, based in the EU, and with a specific focus on innovative technologies. So we haven't contemplated the use yet of this mandate in our climate and environmental impact activities, but we are certainly on the lookout for funds that are seeking to raise funds of this critical mass and that can support clean tech scaling. As you may have heard, the European Commission also announced yesterday a new Green Deal industrial plan, which we think will also help with this, the financing gap for hardware technologies. We're also actively working, with our EIB and EIC colleagues to make sure that the portfolio companies of the funds that we back get a full array of financing instruments. And certainly in hardware scaling, you don't only need, equity products, but you also need grants, you need debt. And so, for example, we're systematically introducing our fund managers to our venture debt colleagues at the EIB, as well as counterparts and other national promotion agencies that can help with other financing instruments. So again, very sensitive to the needs of hardware innovation and really wanting to make sure that critical hardware innovation sees the light and makes it to market. So with that, maybe we can move to another question. I'm not sure if we have other questions that have popped up on the chat. Otherwise, I'm going to retrieve one that we received previously. This is a question for Marilyn. So how do transparency and reporting requirements at a larger scale, so for example, the EIB, cascade down to SMEs who receive funds? The granularity and scope for financial intermediaries does not always match with the beneficiary's capacity to supply data.
Thank you. It is it's a good question. I think we have to recognize, of course, that we understand it's a new framework. Also, the taxonomy framework is new. The market is still learning and adapting to the criteria. And we definitely also see a data and reporting cap coming actually from the companies themselves, from the SMEs. We do recognize it, and that's why also we have not yet rolled out fully the full taxonomy technical screening criteria assessment. We have adapted it, as I mentioned, in some sections, or we are not yet fully really requesting activity by activity assessment of all of the do no significant harm criteria. And we're also engaging with the colleagues of the EIB and the advisory services in the hope that we can indeed explore the development of new tools that could help with the assessment, with understanding the criteria more, but also in calculating some of those green impact indicators that I mentioned. I think we have been quite fast in our ambitions, and now we need to work a little bit more on the tools and guidance, and always happy to receive the feedback also from the market to understand what could be done better or more, or where really are the difficulties.
Thanks, very helpful, Marilyn. Another question for Paula, I would say. Are the InvestEU funds for VC fundraising already depleted for 2023? And if so, can we already engage now in 2023 to target a first close in early 2024?
So if the question is, have we decided already which are all the funds that are going to receive InvestEU support in 2023? The answer is not. So we encourage eligible funds operating in relevant industries to apply. I would say that applying now for an early 2024 first closing is good timing. Sometimes, for example, in the case of first-time teams, it might take us to assess the proposal up to 12 months, according to what I've heard from our colleagues in front office. But maybe you can as well complement.
Yeah. Certainly, no. Obviously, we're evaluating proposals as we speak, and we have a very advanced pipeline. But not all resources have been allocated yet. So please do knock on our door. And if you engage with us now, probabilities are that if all goes well, we will be able to formalize a commitment to your fund in early 2024. So yeah, please do reach out and present your fund proposals. Maybe building on this question, another one that we actually received is, how we go about allocating resources to the fund proposals that we receive. I'm not sure if one of my colleagues would like to take this question. And so the question more concretely is, what are the key criteria in your approach when making a decision on resource allocation for funds? What is the ultimate differentiator, if any? Does anybody want to step in?
I think I could take that one.
Okay, great. Thanks, Priscilla.
I mean, as a general feedback, there are a number of criteria that we look at, and I think you've also noticed it throughout the presentation. So there are certain factors that will count positively, other factors that might have, well, a neutral or even negative effect. And then we always look from, let's say, a commercial perspective, and then also we look what is the requirement under a specific mandate. And the combination of both then leads to the decision that is taken, and usually or like always discussed with you in an interactive way. And I think also to underline also what Adelaide said before, there's still room for applications. We actively encourage fund managers to apply, also to interact. We're happy to provide support or guidelines where needed. And yeah, and then I mean, maybe last point, it's assessed on a first come, first served basis. So yeah, we're always happy to receive feedback. I don't know if anyone else would like to add.
Great, thanks, Priscilla. Well, I think if there aren't any further questions from the chat, I think this last question probably brings us to a close. As mentioned, we'll strive to respond to the questions that might have been left unanswered, via a Q&A document that we'll complete as a follow-up to the session. We'll also, as mentioned in the chat, make the slides available in the coming days, as well as a recording of the session that will be uploaded onto our YouTube channel. Maybe if we can bring the presentation back up on the screen, because we have a few last slides with some links and resources. Okay, great. So here, as you can see on the slide, you can follow us and our latest news stories on social media, which, of course, includes LinkedIn, Twitter, and Instagram, amongst others. As Paula said during the presentation, for any queries, regarding this presentation, InvestEU, or the CAS framework, please address them to our InvestEU EIF email address, which is shown at the bottom of this slide. And moving now to the next slide and the next one. So we've also included here as an annex a number of links to resources that are related to our climate and ESG policies and frameworks in case you wish to learn more. And, it's basically, covers the InvestEU call for expression of interest, our ESG principles, our brochure on climate, as well as our the group's climate bank roadmap. And last but not least, and before you go, we would really kindly ask you if you could fill out the feedback form, which will open up in a new window when closing WebEx. Your input is really invaluable to us and will enable us to better address the topics that may be of interest and prepare also for subsequent sessions. So we hope you found the presentation interesting, and on behalf of all of my colleagues and the EIF, thanks very much for joining us today.